to the markets at the debt downgrade, which is, I think Moody's felt like, hey, you know what? We had S&P and Fitch do it before. It's our turn.
Yeah.
So, they downgraded U.S. debt rating from its best highest rating to one notch below. Yields increased slightly on this. The 30-year went up to 5%. The 30-year was 5, 10 years, 4.5. And just to put this in perspective, because I want to break this down, because there's so many stories talking about it, the significance of it and everything. And I'm not saying it's not significant, but we're above 4.5 in January. We're above 4.5 in May of last year. And also closing in at 5% in October 2023. And every time we hit these levels, bond yields have fallen. But I wanted to take a step back to explain what this means, because I think people just believe, holy shit, shit's going to hit the fan. It's really bad. And I like that they did this, because they should have did it, because it's, you're seeing debt levels skyrocket, and it's insane right now. We need to do it. Everyone's talking about it. Everybody's saying it. You have Ray Dalio to, Jamie Dimon to, President of the United States, to everyone saying like deficits, right? We all know. So when we see this debt downgrade, it results in rates going higher, as, that slight concern that the U.S. won't be able to service its debt. But to be fair, people have been making this argument since the 1970s. Okay?
And they've been right.
And, well, they haven't been right on their Armageddon call, because they're talking about the entire financial collapse. System's going to collapse. Dollar's going to lose its world's reserve currency status. I mean, Porter's all over this again. Someone I follow and I used to work for is saying that Bank of America is going to go bankrupt. They have $500 billion in treasury bonds at 1%. They're worthless if yields hit 7-8%, but they're not worthless if they hold them to maturity. But, he's one of many predicting this total Armageddon scenario. And as we all see deficits go higher and higher, and what are we at, 36 trillion now, and to service that debt, which means the interest payments alone are over $1 trillion. It's freaking insane. With that said, okay, being real with you, our Fed has the ability to lower rates considerably from here. That's short-term rates. Long-term rates can still stay high. But inflation is not spiraling out of control right now, even with the tariff nonsense. Also, you look at GDP was, if you're going into recession, it's a big deal. Now we're seeing growth, because growth is the remedy for this. It's the only remedy. You could say we're going to cut here, we're going to cut here, or there. It's growth. And now we're seeing GDP growth pick up tremendously, where the Fed is, 2.3% now, which was, again, we had a negative print last quarter. Should we be worried about debt levels? Absolutely. Should you pull all your money out of the stock market and hide it? Absolutely not. I think it's important to highlight it. I don't disagree with that downgrade. I think it should be, hey, you know what? It's time to put this on the map that everybody knows that they're talking about it, which if, you're hiding under whatever, you should know about the deficits and how crazy they are and how much we spent the past few years after COVID. But, I wanted to get your opinion first, because I'm going to dig a little bit deeper in here what it means for your portfolio. So
I liked how you point out they were late to the game. I had to look this up, but Standard & Poor's knocked us down in 2011. 2023, it was Fitch, and now Moody's is late to the party. I like how Secretary of Treasury Bessent said it was a lagging indicator. But for the Mr. Obvious out there, we're 36 trillion in debt, 100 trillion in unfunded liabilities, well above that number. And you and I, neither one of us can fathom $100 trillion, even though we try to act smart and stuff. So to consider, Frank, it's a 21-point notch rating, I believe. So they did 1 out of 21. I think that's what I read. That's impressive. Rounding up, that's a whole 5 percentage points. Let me be clear. We're obviously the cleanest dirty shirt, Frank. If you have trillions, hundreds of trillions, goofy numbers, you don't think you don't deserve the best Florida credit rating in the world? Are you kidding me? This is insulting on so many levels, because it's like, hey, and again, what I mean by they're right, everybody says, oh, it's unsustainable. We're unsustainable. Fed Chair Powell says it. Secretary of Treasury Bessent says it. Donald Trump says it. Every elected idiot says it. Point is, it can go on for decades. It can go on for much longer than we think. It worries you. It makes me nervous. It should, but it shouldn't push you to the point of, as Frank just said, selling everything. Frank, last thing on Dalio, and I like what I think he's trying to do here. I just think he's doing it in a not so good way of PR, because he did say, hey, the downgrade's even worse because they don't talk about how they're going to have to, they being the government's going to have to print money to get out of this situation, which is going to amplify the concept. At least they're calling attention to that. But what it does is it brings front and center the great conversation, and maybe we segue into this. It's no coincidence that gold and Bitcoin are at all-time highs or near, because it's not the end of the world. So if somebody says, hey, the U.S. dollar is going to continue going down and it's so unsustainable and we're really going to have some remaking of the system, okay, have exposure to gold and Bitcoin. You're safe. And then enjoy all the fear and craziness on the internet, but laugh at it. Because, Frank, that's the answer. Have exposure to gold and Bitcoin. And you know what? You take the end of the world out of the scenario. So back to you, Frank, but do not take this too seriously and do not allow this to make you sell out of assets that have a tailwind because of the stupidity that led to the downgrade in the first place.
Yeah, and we'll see this shit start hitting the fan through yield spreads, which are still narrow, showing that we're okay. We're all talking about these high debt levels, which means a lot of this is factored in already, all right? And it's nice to see everyone talking about it because during the credit crisis, we weren't. And for those who are calling for Armageddon, two things. The last time we saw a global financial crisis, 2007, 2008. I'm not talking about COVID because we just spent a ton of money. We knew the economy was going to open up, right? This is something like a global financial crisis where we're like, holy shit, what's going on? We have no idea because of our shitty banks and, and what they did, right? And leveraged themselves, made fortunes. Nobody went to jail. We all know this, the scenario. But what do we see our government do? They did the unthinkable. They invested in all these companies and bailed out everyone. And I always said this is the worst thing that ever happened. It wasn't just a global financial crisis. The government did what they had to do because we probably still have a 35%. Right now, if we did nothing and people are like, well, let the markets do what they want, we'd probably have a 30% unemployment rate even to this day. A lot of banks would have disappeared. People would have lost their money. They did what they had to do to make sure the system was solvent, right? But the worst thing to happen is the government made a freaking fortune on everyone they bailed out. Every single one. AIG, the big banks, Fannie, Freddie, they're still in conservatorship making billions of dollars. So what does that mean? The government's going to spend an unlimited amount of money before we see a big bank have a run on it, which we can't because if you thought they were too big to fail then, they're all 3 to 5x bigger than they were back then, the 4 largest banks. So they are going to spend a massive amount of money to bail us out again and again. And that includes the Fed and lowering rates. Number 2, all the people who are calling for Armageddon and the dollar will lose its reserve currency status and the market's going to crash 50%. I can tell you personally, not one of these, and I'm not going to curse here, not one of these people are short the market. They would never short the market and they never will be short the market. They're going to claim that, oh my God, it's the end of the world. And in fact, they're all trying to sell you some financial product and subscription, which is hilarious to me because everything is going to crash outside of the price of gold. Don't buy gold stocks. They've always crashed when the market crashes. And Bitcoin, right? So the fact that so many of these people have been calling for this in the 1970s and never have gone short, but they forced so many people to pull their money out of the markets for decades and decades is a shame. But I would love to see these guys' portfolios where if you really think the market's going to fall, show us your portfolio. Show us that you're short. I want to see it, okay? Don't just say it and say, oh, well, we're going to help you out if you subscribe to our product, which has stocks in it, right? Which is a joke to me. So when I see this, it really pisses me off. If you really feel this way and you think the market's going to crash and because the dollar loses reserve currency status, I don't think people grasp that concept of what actually happens. That means we lose our freedom. That means we get taken over as a country. That means our houses get raided. You have no assets anymore. People don't talk about like that full extent if we don't have the reserve currency status, which again is not going to happen. It's not going to happen in our lifetimes, but we have to be concerned about this. Our advice has always been for well over 10 years, right? Especially when it comes to Bitcoin. We recommend Bitcoin since, 6,000, right? 6,000 is still in our portfolio, in our crypto portfolio. Our advice has always been own Bitcoin and old gold as insurance. That's it. Own those two. Has gold done anything? No, it hasn't done anything. But you didn't hear us shouting at the rooftops and yelling at all the Bitcoin people. You're assholes. You have no idea. At 7,000, at 12,000, at 50,000, at 70,000. You're an asshole. You're an asshole. Michael Saylor's an asshole. He has no idea what he's talking about. It's now 110,000, right? Closing in on that. It's at all-time highs. It's going to continue to go higher. But now we're seeing the move in gold, and gold starting to go higher too. That's insurance on your portfolio. Have 5 to 10% of it because my gold portfolio has done shit for 5-7 years, but I wasn't all in on gold. Don't go all in on gold. Don't go all in on Bitcoin, even though if you went all in on Bitcoin, I know you could say, well, I went all in and I got a lot of money right now. I get it. But you weren't saying that when it crashed to below 60,000 not long ago, okay, because it is volatile. But those should be staples in your portfolio, 5 to 10%. I wasn't complaining when gold hasn't done well. I was in a lot of stuff that offered me 5-year warrants. I was able to cash in. Now gold's doing better, right? But it was a good 4 or 5 year stretch where they've done nothing and we've taken losses on some of these things. Now is a great time. Gold going higher. A lot of these projects make sense, right? They haven't drilled. We don't have, they just undersupply so much. Now you bring those junior miners in play that do have good projects that nobody cared about. Now they're starting to care and they're starting to get permits for them. And it's going to be a lot easier to get permits for them, especially in the U.S. with the new administration. So gold makes sense. Gold stocks make sense. Bitcoin makes sense. Those are the best plays. Own that stuff because that's going to protect your portfolio. But we'll know when things get worse because we'll see the bond market collapse, which we saw recently, which scared the shit out of Trump. And it's why he's like, oh, wait a minute about those tariffs. We're going to have tariffs on China, but we're not going to include electronics, EVs, this, like 10 different, like he just all these exclusions because Bez tapped on his shoulder and said, listen, the market's about to absolutely collapse. And the bond market is telling you that. And that's where you see right now the bond market is not telling you that you need to be extremely worried about it. It's a concern. Don't pull all your money out of stocks. You don't need to. We've said that for a long time. And stocks are approaching, all-time highs now again, right? We're like 5% off, 4% off. Be concerned. I love the fact that everyone's talking about this. It's got to be done with less spending, which could hurt the market because we want to see more spending that drives stocks higher, even if the spending comes from the government, which we highlighted numerous times over the past 5-7 years, especially after COVID. But own gold, own Bitcoin, that's your insurance, and you should be happy with those two hedges right now because they're doing very well, probably the two best performing things in your portfolio right now, especially this year.
Yeah, absolutely. Just quickly, I think, and I'm not claiming that we know all the answers or anything like that, but just frame the question as, what do you think gold and Bitcoin and yields are telling you right now? You have this U.S. downgrade, you have stocks. I know one day doesn't necessarily make a trend, but I'm looking at the markets right now. The NASDAQ is back into positive territory just by a smidgen, but you have the Russell down, S&P down, Dow down, all about 0.5 to 1%. But yet Bitcoin's at a new all-time high. Gold is not a new all-time high, but it's doing well. Yeah. It's not selling off like crazy. The point is there's enough there to understand that the market is telling you, in my opinion, to have exposure to that, because you're not going to have the correlation in those assets that you've had in the past. By definition, it can't stay the same. We don't understand the rate of change. That's what we want to pay attention to. But just try to think in terms of, hey, what is it doing and what is that saying? And I think that that's very helpful.